In today's video, we'll explore the different types of investors. Are you a novice, a player, an informed investor, or perhaps a professional? Stay tuned to discover where you fit in, and don't forget to drop your insights in the comments. Let's get started. Novice investor. If it's rising, they buy. If it's falling, they sell. Consider themselves well-informed and lucky, reacting directly to market news, and making decisions based on their immediate reactions to market developments. When market news indicates an uptrend or a rising asset, they feel compelled to make purchases, hoping to ride the wave of potential profits. Conversely, if news suggests a market downturn or falling prices, their instinct is to quickly liquidate their holdings in a bid to minimize potential losses. These individuals tend to rely heavily on their gut feelings and intuition rather than implementing a structured investment strategy. Their actions can be heavily influenced by the latest headlines, social media buzz, or tips from friends and family. While novice investors may occasionally experience success when their instincts align with market trends, their lack of a systematic approach can also lead to impulsive and emotion-driven decisions. They might not fully grasp the intricacies of financial markets, and their motivations may center around seeking quick gains rather than pursuing a well-thought-out, long-term wealth-building plan. Recognizing the significance of financial education, research, and strategic planning is crucial for novice investors. By developing a sound investment strategy and gaining a deeper understanding of the inherent risks, they can navigate the complexities of the financial world more effectively. Seeking guidance from seasoned investors or financial experts can also prove invaluable as they progress toward becoming more knowledgeable and successful investors. Player investor understands the theory of efficient markets, which suggests that asset prices reflect all available market information. However, they believe that by observing certain companies, they have an advantage over other investors. They try to derive a strategy from the news. When something becomes more expensive, beginners buy it, so they usually do the opposite: sell on a rising market and buy on a falling one, hoping to profit. Player investors possess a solid grasp of the theory of efficient markets, which posits that asset prices inherently incorporate all publicly available market information. However, their investment approach deviates from this theory, as they firmly believe that by closely monitoring specific companies, they can gain a competitive edge over their fellow investors. Their strategy is rooted in interpreting news and events within the market. When they observe a particular asset or stock experiencing a surge in value, player investors take a contrarian stance. Instead of following the conventional wisdom of buying on the rise, they choose to sell, aiming to lock in profits before the asset potentially reaches its peak. Conversely, when they encounter signs of a declining market or falling asset prices, their strategy diverges once more. In contrast to novice investors, player investors see these market dips as opportunities to buy assets at reduced prices with the expectation of capitalizing on future price rebounds. This approach requires a certain level of confidence and a contrarian mindset. Player investors are willing to swim against the current, believing that their insight into specific companies or industries gives them an advantage over the broader market. By attempting to derive strategies from news and market trends, they aim to maximize their returns in both bull and bear markets, exhibiting a willingness to adapt and evolve with changing market conditions. Informed investor. Don't spend time analyzing individual companies for investment. Typically has a steady income, financial plan, investment strategy, a second investment opinion, or advisor. Understand that the stock market is a way of long-term capital preservation, not instant earnings. Buys in planned quantities and according to a strategy. Rebalances their portfolio after each investment tranche. In other words, they buy a certain amount of each position, so that after buying, the portfolio structure is as close as possible to the target. Such rebalancing automatically allocates more to positions that have become cheaper and less to those that have become more expensive. News changes, leaders, and outsiders in the portfolio change places, and such an investor breaks the ice like an icebreaker. Professional investor works in finance and investments, earns like a player investor, mainly from commissions, not results, from clients' portfolio turnovers, has the time, inspiration, experience, technical and informational capabilities, preserves capital like an informed investor. Now that we've explored the different types of investors, take a moment to reflect on your own investment style. Which type of investor resonates with you the most? Or perhaps, which one do you find most intriguing? So, don't hesitate. Share your thoughts in the comments section below. Let's create a vibrant discussion where we can all learn from each other's perspectives and experiences.